The final days of any year carry a particular quiet in the world's financial districts. Trading floors stand half empty. The frantic energy of November is a distant memory. To a casual observer, it appears the system is resting. This, the analysis would suggest, is an illusion. Beneath the surface calm, a precise and powerful mechanism is engaging. Its gears are not controlled by a shadowy group, but by lines of regulatory code. Its function is not to manipulate for profit, but to ensure survival. And its annual operation creates a predictable, temporary distortion in the value of a critical strategic asset. This is the story of that mechanism, and the confidential intelligence its operation reveals. To understand the event, one must first define the players. The title speaks of they. In this narrative, they are not a secret cabal. They are a legally defined class, the global systemically important banks, or G-SIBs. These are the largest, most interconnected banks on Earth, household names like J.P. Chase, Citigroup, and the Bank of America. Their designation is not honorary. It is a regulatory label that comes with a heavy burden. The world's financial guardians, through agreements like Basel III, have decided these institutions are too big to fail. Therefore, they must be made exceptionally safe. The tool for this safety is capital. Their own money they must hold in reserve as a cushion against losses. The engine of the entire phenomenon is a simple, brutal rule. On the final day of each year, December 31st, a snapshot is taken of each G-SIB's balance sheet. In that frozen moment, regulators measure the bank's risk. They tally all its loans, investments, and derivative positions, weighting them for danger. The final number from this snapshot determines how many billions of dollars in extra capital the bank must lock away, unable to earn a return for the entire coming year. It is a report card that costs a fortune to fail. This creates a universal incentive. For the last 48 hours of the year, every major bank on that list is engaged in the same rational behavior. They must look as safe, as small, and as liquid as possible for the camera. They sell assets. They close out trading positions. They call in short-term loans. The goal is to shrink the number on that balance sheet snapshot to appear capital light. This is not a conspiracy. It is a uniform, logical response to a fixed rule. Financial professionals call it window dressing. But this is window dressing on a trillion-dollar scale. This is where a unique commodity enters the story: silver. It is not the only asset sold, but it is a uniquely perfect one for this purpose. Why silver and not gold? Gold is a monetary metal, a pure financial asset. Silver is a schizophrenic asset. It is both a monetary metal traded in vast paper markets and a critical industrial component. It is in solar panels, electric vehicles, and advanced electronics. This duality is key. The deep, liquid paper market, the futures contracts, allows the banks to sell enormous quantities quickly and easily to raise cash. They are not necessarily betting against silver. They are using it as a pressure release valve. It is the ideal temporary sacrifice to please the regulator's formula. The evidence is in the pattern itself. A historical analysis of silver's price action reveals a curious, repeated footnote. Across multiple years, a tendency emerges for weakness in the final week of December. This is not a guarantee every single year, but the statistical footprint is clear. It is a subtle dip, often recovered swiftly in early January. To the untrained eye, it is noise. To the analyst, it is a footprint, the mark of a large institutional foot stepping in the same spot year after year. It is the signature of the mechanism at work. Therefore, the stage is now set. The actors are defined, the G-SIBs acting under regulatory compulsion. The rule is established, the year-end capital snapshot. The target is identified, silver, due to its dual nature. The pattern is noted, the recurring late December pressure. This explains the what and the how. A predictable, systemic event occurs because the rules of the system demand it. But this is merely the prologue. The confidential information, the true intelligence, is not in the mechanism itself. It is in what this forced, annual sell-off inadvertently reveals about the true state of the market. It is in who is waiting on the other side of these trades, and why their presence turns a regulatory exercise into a strategic blunder. The mechanism, in its cold, logical operation, pulls back a curtain. And what it shows is a landscape far different from what the falling price suggests. The superficial narrative is simple and alarming. A chart flashes red, headlines spike. The price of silver drops sharply, seemingly out of nowhere. In late December, the immediate story told by the flickering numbers is one of collapse. The rally is broken, the bulls are routed, the momentum is dead. This, however, is the noise. The true signal requires a different kind of listening. It is found not in the destination of the price, but in the journey. It is read in the structure of the decline and, more importantly, in the market's immediate reaction to it. The confidential information begins to leak not from a document, but from the tape itself. Consider the anatomy of a typical late December sell-off. The price is pushed down, often to a precise technical level. It might drop to a previous breakout point, a round number that once served as a ceiling. For the sake of analysis, imagine the number 70. The price crashes towards $70, breaches it momentarily to $70.50, and then stops. It does not continue to 68. It does not plunge to 65. It finds a floor, not of sand, but of concrete. On the chart, this action prints a specific signature, a long, thin line extending downward, a wick, with the body of the price bar recovering to close much higher. In the language of technical analysis, this is called a rejection. The market went down, looked at the lower price, and said, no, this is too cheap. This rejection is the first crucial piece of data. It indicates that beneath the frenzy of the forced sellers, a different kind of order exists. There are buyers waiting with clear instructions. Acquire the asset at or near this specific value. These are not emotional traders chasing momentum. These are strategic bids, likely automated, programmed by entities for whom price, not timing, is the primary concern. They are the market's immune response, appearing precisely when the asset is under stress. The second and more powerful truth teller exists halfway across the world. While the paper price of silver in New York is being slammed down, one must ask, what is the price for immediate physical delivery in Shanghai? This is not a futures contract promising metal in a month. This is the price to get a bar of silver into a factory now. The data here is stark. Even as New York falls, the Shanghai price often remains stubbornly higher. A gap, sometimes of several dollars, remains open. This is the physical premium. It is the market's way of screaming that actual usable metal is scarcer than paper promises. The forced New York sell-off does not close this gap. It may even widen it temporarily. This proves the sell-off is a paper phenomenon, failing to touch the harder reality of physical demand. The arbitrage signal, buy in New York, deliver to Shanghai, remains flashing, but the banks, hamstrung by their year-end rules, are powerless to act on it. So, if the banks are selling and the price is finding a floor, who is buying? The analysis points not to other speculators, but to a different class of owner entirely, the strong hands. These are industrial consumers, a car manufacturer, a solar panel company, whose need for the metal is not discretionary. It is built into their production schedules. These are also sovereign wealth funds or physical accumulation funds that view the metal not as a trade, but as a long-term strategic holding. The G-SIB sell-off, in effect, provides these entities with a subsidized annual procurement event. A transfer of inventory occurs, invisible on most screens. Metal moves from the weak hands of leveraged, short-term paper traders who are stopped out or capitulating into the strong hands of those who will take it off the exchange, vault it, or melt it into a product. This transfer represents a profound strategic error from the perspective of a short seller. The goal of a short sale is to buy the asset back later at a lower price from a panicked seller. But if you sell your silver and the buyer on the other side is a sovereign fund that immediately withdraws it from the market for a decade, you have not created a future-willing seller. You have eliminated supply. You have sold water in a desert to someone building a sealed reservoir. You have made your problem of covering your short position infinitely harder, because the thing you need to buy back no longer exists in the tradable ecosystem. The final contextual clue comes from gold. Silver's more reserved sibling often acts as an anchor. In these periods, while silver, the volatile industrial metal, swings wildly, gold, the deep monetary asset, typically shows remarkable stability. It may dip slightly, but it does not crash. This tells a clear story. The selling is specific and technical. It is not a broad-based flight from precious metals or a collapse in the macroeconomic fear that drives them. The foundation is still solid. The floor for the entire complex remains firm. Therefore, the confidential information begins to crystallize. The annual sell-off is not a demonstration of bank power over the market. It is a moment of forced transparency, a stress test imposed by the regulator's own rules. By their compelled actions, the banks reveal the hidden architecture of real demand. They show where the concrete floor lies. They highlight the unbridgeable gap between paper price and physical reality. And most critically, they expose the waiting presence of strategic, physical buyers who are not intimidated by a temporary price drop. They are energized by it. The mechanism, designed to make banks look safe, inadvertently broadcasts their vulnerability. It shows that their temporary necessity has become someone else's permanent advantage. And this sets the stage for the inevitable, asymmetrical reaction that follows the moment the calendar finally turns. The transition is marked by a global celebration. At the stroke of midnight on January 1st, fireworks erupt over cities, toasts are made, and a new year is welcomed. In the silent, digital ledgers of the global banking system, another change occurs, one far more consequential for the markets. The regulatory snapshot is complete. The moment has passed. The intense pressure that forced the G-SIBs to sell assets vanishes as suddenly as it appeared. The rules relax. The banks can breathe again. They are no longer penalized for holding risk on their books. This quiet shift flips a fundamental switch in the financial ecosystem. What happens when an artificial, overwhelming selling force disappears while the underlying buying force it exposed has just been made stronger and hungrier? The immediate effect is a vacuum. For 48 hours, the market was dominated by one kind of order: sell. Now, those orders are gone. But the orders they triggered, the strategic bids at $70, the physical arbitrage bids, they remain. They are now operating in a market where the largest, most motivated seller has abruptly left the room. The pressure release valve has been closed, but the boiler of demand is still building heat. This creates a fundamental imbalance in the very first days of January. Liquidity, which was artificially high due to the forced selling, often drops just as new buyers arrive. These new buyers are driven by a different, equally powerful calendar. Pension funds, large endowments, and sovereign wealth managers return to their desks in early January. They have fresh capital to allocate for the new year. Their process is methodological and cold. They look at the performance leaderboards from the previous year. Which asset classes delivered the highest returns? Their mandate often compels them to rebalance their portfolios toward these winners, to chase what the finance industry calls alpha. If silver topped that performance list in the previous year, and the analysis suggests it very well could have, it now appears on thousands of institutional screens flagged as an under-owned asset. These entities do not buy in ounces. They buy in tons. Their entry is not a sprint, but a steady, relentless accumulation. This creates a critical dynamic. Two different types of buyers, facing a depleted pool of sellers. Recall the nature of the December buying. It was the strong hands taking advantage of a discount. The January buying is different. It is the real money institutions executing an annual allocation. The first group was soaking up supply to remove it. The second group is arriving to establish new long-term positions. They are both acting as a drain on available inventory. Meanwhile, the G-SIBs themselves may now need to become buyers again, not to speculate, but to simply restock their trading inventories and facilitate client orders. Their role flips from urgent seller to necessary purchaser. The technical picture now adds rocket fuel to this fundamental setup. The most powerful chart in finance is the yearly chart. The closing price on December 31st sets that candle in stone. Imagine a yearly candle that, despite the late dip, closed near its highs for the year, a long green bar signaling total annual dominance by the buyers. This single image triggers automated responses across global markets. Trend-following algorithms, which control billions of dollars, are programmed to buy assets that show strong yearly momentum. A strong yearly close is not a suggestion to them, it is an instruction. This generates a wave of automated, emotionless buying at the very moment human buyers are also entering the market. It is a convergence of capital flows. The physical market, the ultimate judge, delivers its verdict. One would think that after a price smash, the premiums charged for actual coins and bars would collapse. Yet the data often shows the opposite. Premiums remain high, or may even increase. This is a telling detail. It means the retailers, the individual investors, and the industrial stockpilers are not selling their metal into the price drop. They are buying it. The public sees the dip not as a danger, but as a discount. This lack of secondary supply, the absence of people melting old jewelry or selling their coin collections, removes a natural braking mechanism from the market. The hoarding mentality sets in, further tightening the available supply, just as large-scale demand returns. All of this occurs against a quarterly backdrop primed for volatility. The first quarter brings corporate earnings calls. Chief executives of technology and green energy firms may begin to openly discuss supply chain strains and rising input costs for materials like silver. Central banks continue to grapple with inflation figures that stubborn metals prices seem to contradict. Geopolitical tensions simmer. The temporary distortion of December has, in effect, coiled the spring of the silver market tightly. The G-SIB sell-off did not change the fundamental story of deficit and demand. It merely delayed the pressure buildup. Now, with that temporary release valve sealed and with multiple new sources of pressure applied from institutional, algorithmic, and physical buyers, the conditions are set not for a gentle rise, but for a forceful move. The asymmetry is complete. The artificial selling of December directly created the explosive buying vacuum of January. The confidential information is now a playbook, written in plain sight by the regulators themselves, detailing a predictable annual transfer of advantage from short-term, balance sheet-focused entities to long-term, asset-focused strategists. The only remaining question is one of magnitude and timing. It is a case study. It reveals a fundamental and growing tension within the modern economic system. This tension lies in the conflict between the world of paper, of digital claims, balance sheet accounting, and regulatory formulas, and the world of physical reality, of scarce resources, industrial necessity, and tangible value. The annual silver event is a symptom, a predictable flare-up that illuminates this deeper condition. For the business-minded observer, the confidential information is no longer just about a metal. It is a framework for understanding a new kind of risk and a new kind of opportunity in the global marketplace. The core dynamic presents a crucial business lesson: the redefinition of inventory. In a traditional physically grounded market, a commodity like silver is inventory. It is a vital input, a stored asset, a strategic reserve. However, within the highly engineered financial system of a G-SIB, that same commodity can transform temporarily into a liability. It becomes a risk-weighted number on a spreadsheet that threatens to trigger punishing capital requirements. The smash is the moment this asset is sold, not because its fundamental value has changed, but because its accounting treatment has become inconvenient. The intelligence lies in recognizing this flip. The entrepreneur who understands that a key supplier might be forced to dump product not due to market forces, but due to arcane financial rules, gains a powerful strategic advantage. They can position themselves to be the buyer of last resort, converting another entity's regulatory problem into their own inventory solution. This leads to the inevitable endgame of the arbitrage now laid bare. The persistent gap between the New York paper price and the Shanghai physical price is not a stable anomaly. It is the unstable imbalance, like a charged battery. Physics and economics both abhor such imbalances. They seek equilibrium. The only ways to close this gap are straightforward, and both are bullish for the suppressed price. Either massive, new deliverable supply suddenly appears in the West, a geologically impossible event in the short term, or the New York paper price must rise, violently and decisively, to meet the hard reality of the Shanghai price. The G-SIB sell-off, by temporarily pushing New York further down, does not solve the imbalance. It worsens it. It stores more potential energy in the system, making the eventual correction sharper and more severe. The mechanism, in trying to solve a regulatory problem, inadvertently wires the market for a more powerful fundamental correction. The pattern extends its relevance beyond a single commodity. This is a modern template for wealth transfer in an age of scarcity. One can observe similar, though less dramatic, pressure points in copper, lithium, and rare earth elements. In each case, deep financial markets and derivative instruments exist alongside intense geopolitical and industrial competition for the physical material. The same dynamic emerges. Entities focused on quarterly financial statements can be forced to make decisions at odds with long-term physical strategy. The business analyst or young entrepreneur trained to spot this pattern, where financial engineering collides with physical scarcity, gains a lens to see future crises and opportunities long before they reach the headlines. They learn to ask, what is being treated as a paper liability today that will be a physical necessity tomorrow? For the individual, this translates into a sober audit of one's own balance sheet. This is not a call to speculate on silver. It is a call to apply the principle. Are your assets, or your company's assets, purely financial claims, stocks, bonds, currencies, that exist only in digital registers? Or do you have a strategic allocation to unconcentratable real assets, things that cannot be printed or replicated at will, that serve as a hedge against systemic frailties? This is not investment advice, it is risk management doctrine. In a world where the largest banks can be compelled to act against their own long-term interest by a line in a rulebook, diversification must mean more than spreading money across different digital tickers. It must consider the very nature of what one owns. The final, and perhaps most difficult requirement is psychological discipline. The market will remain volatile. Headlines will scream of new crashes and new peaks. The banks, having taken losses, may attempt to reassert control. The noise will be deafening. The business mindset, therefore, must learn detachment from the daily price. It must focus instead on the slow, deep currents, the inventory drain figures, the industrial consumption data, the shrinking levels of metal in registered warehouses. Price is a flickering shadow on the wall. The flow of the actual asset, from west to east, from exchange vaults to private hoards, is the solid object casting the shadow. The confident strategist watches the object, not the shadow. In summation, the annual ritual reveals a quiet battlefield in plain sight. On one side stands speculative leverage-driven capital, answering to quarterly reports and regulatory snapshots. On the other stands strategic, patient capital with a sovereign or industrial purpose, answering to decade-long plans and physical needs. The confidential information is that this battlefield has a scheduled event each December where the former is compelled to retreat, offering the latter a recurring tactical advantage. To understand this is to understand a fundamental rule of the emerging economic order. In an age of limitless digital abstraction, the ultimate strategic leverage may well lie in a deep understanding of those things that cannot be copied, cannot be delayed, and cannot be conjured from a keyboard. The system, through its own rigid rules, is now telegraphing exactly what those things are,